Good morning. Welcome to Core Services and our Core Belief Series, Why It Matters. Today we're going to discuss audit objectives and why they and their impact to associations and why it matters to really understand the difference between the various types of audits. I'm John Coggle and I'm today's presenter. A little bit about Core Services. We are focused on audits and reviews. We audit primarily condos and HOAs in Oregon and Washington. And we have over 40 years of combined experience working with these types of associations. And we also offer advisory services to help board members in their oversight capacity. So, the audit objective. It really does depend on what type of audit we are talking about. From our standpoint, we typically, when we are talking about an audit, we're talking about a financial statement audit or an audit under generally accepted auditing standards. And these audits are actually really designed to provide a opinion from the auditor that the financial statements are fairly stated. And so that means that we're looking for compliance with the accounting principles, generally accepted accounting principles, or cash basis or income tax basis, depending upon how the financial statements are being prepared. So we're looking for to make sure that all the disclosures are there, that the revenue recognition is being followed correctly, and this actually leads to the financial statements are free from material misstatement. So that means that you're not claiming a receivable and the corresponding revenues before the point of revenue recognition, that you've recorded all your expenses for the period. That's what we're really looking for in a financial statement audit. In an internal control audit, you're really looking for the process. So you're looking to make sure that they've documented that first step A happens and then step B happens and step B is done by somebody else. Okay, how do you prove that every transaction goes through that process? And so you have to obviously document the internal controls either through flowchart or through narrative. And then you have to be able to prove that B signed off, A signed off, D signed off. And sometimes that's merely an initial on the document, or if it's computerized, the user logs in with their username and password and clicks a box, and they're the only person, or that they are the only level of management that can approve a transaction. And what the objective of that internal control audit is that the process is free from material deviations. So the transaction, just because it's been initiated by A, cannot be completed, and because B didn't agree to the transaction, didn't approve it through their control process, did that transaction still go through? And if it did, you may have had a material deviation. In the forensic audit is actually comes after the point of identifying a specific issue. You would, from our perspective, when we're doing a financial statement audit, if we see a transaction that occurs, and so for instance, one was the community manager hired a contractor, and the management company didn't realize that the community manager was actually the owner of that contractor. And so the community manager was able to choose that contractor to come in and do work on his associations. Obviously the internal controls weren't working, but since that transaction was identified, now the rules are: what is the extent of that potential problem? What is the risk to the organization? How much money is potentially out there that this transaction impacted? I mean, if it was $100, that's one thing. If it's $100,000 worth of transactions, that's something else entirely different. So understand that, again, I mean, if it's identified at the financial statement audit level that there's a breakdown of the internal controls, and it doesn't matter whether an internal control audit was performed or not, the financial audit is not designed to determine the extent dollar value of that irregularity. That's where the forensic audit takes over. So for that condo and HOA, what you really have to understand is, universally, almost all states require some sort of CPA opinion on the financial statements, and that's a financial statement audit. We're going to perform that audit under GAS. If it's a review, it's going to be performed under S.A.R.S, Statement of Standards on Audits and or Accounting and Review Services. So it's a test of the transaction. So we might say out of 100 checks, we might pull 4 or 5 to ensure the supporting document exists, that it's been appropriately signed off, that if the transaction went over budget, there was a board approval. So we're looking to make sure that the transaction is appropriate all the way through, but we are not testing the internal controls. We have to have an understanding of the internal controls. We have to assess whether they are going to be effective, but we are not going to rely upon those internal controls. And that's only because we are focused on the financial statement reporting. So we're looking to make sure the financial statements, the balance sheet, statement of operations, statement of cash flows are accurate, and that the disclosures are effective for the potential reader of that financial statement. So if you are concerned about how well your organization is doing as far as controls go, you can have an internal control audit performed. For most associations, it is not recommended because there are just too few transactions, and chances are the entire internal control structure is not well documented. You might have great policies at the board level, but the management company may not have appropriately documented internal controls, and more importantly, they may not have any way of testing their internal controls to ensure that they're working correctly. And or vice versa, they may have all the great documented controls, and it gets to the board, and the board doesn't keep minutes. So yeah, at the management company level, where they're dealing with multiple associations, and they want to be able to go back to the individual auditors of those associations and say, hey, look, we have an internal control process and we have it audited, so you can rely upon our internal controls. That would work, but it's not going to work for the individual association. And I say that, and then I will caveat that with saying, if you're a large association that maybe has a golf course and a clubhouse and maybe a dining hall, it may be appropriate to go into those various areas, make sure that the control process is documented, because there's going to be a lot of transactions that are going through that, and you'll want your auditor to rely upon your internal control process to determine that things are appropriately recorded in the financial statements. When would you want to look at that forensic audit? When, like we talked about, what you're looking for is you've identified a transaction that doesn't follow any set of rules you have. Somebody signed a check that they are not an authorized signer. That's a flag that something is broken down, and you need to determine the extent of it. And what you're ultimately doing is you're going to go through the entire population of transactions to identify those that fit the pattern, and it's because you want to know what is the dollar extent of this problem. So why does it matter? Well, again, understanding that the financial statement audit is designed around an opinion that the financial statements are reasonably and materially correct in relationship to the appropriate accounting standards framework that's being followed. That's all it's designed for. It is not going to look for collusion. It's not going to look for control overrides. If they exist, they will likely not be discovered in a financial statement audit, and when it does, I would argue it's probably not a fluke. There's just not enough transactions in an association, most typical association, to say that a breakdown that is caught is not extensive within the association. When you're looking at that internal control audit, again, if you've documented your internal control process all the way through and you want to be able to rely upon it, get that internal control audit. It might be worthwhile to you. It'll reduce time and energy and lead to better results. Finally, for that forensic audit, if you find something that doesn't match the internal control system, you'll want to dig deeper, and you're ultimately looking for the dollar impact of that transaction and ultimately the extent and how the breakdown occurred. So anyway, hope this has been informative. If you have any questions, feel free to reach out to us at core-acct.com, or you can contact me through Twitter, or you can contact either me or Doug through LinkedIn. Have a great day, and we look forward to our next presentation.